Welcome, curious minds, to another deep dive. Today, we're tackling something really practical but fascinating, navigating the tax world between the U.S. and South Korea.
Yeah, it's a complex area. You've got these two quite different systems, right?
Exactly. The U.S. taxes its citizens on worldwide income, doesn't matter where you live. But Korea, it taxes based on residency.
So right there, you see the potential problem.
Mm.
A big risk of double taxation for, well, anyone working or investing across borders.
Right. So our mission today is to dig into that, find those critical nuggets that can save you from, costly mistakes, but also maybe reveal some strategic advantages.
Some surprising ones sometimes.
Let's unpack it.
Okay, so the main tool we have here is the convention between the U.S. and Korea for the avoidance of double taxation. Let's just call it the treaty.
Much easier.
Yeah, it's designed specifically to sort of smooth out these conflicts, and we'll look at how the treaty works alongside things like the foreign earned income exclusion, the FEIE.
Right, that lets you exclude a good chunk of foreign income.
Exactly. And the foreign tax credit, the FTC,
Right.
which lets you use taxes paid in Korea to offset your U.S. tax bill.
Okay.
These are powerful tools, and we'll also touch on, for businesses, the whole permanent establishment risk.
Ah, PE. That sounds important.
It is. And for individuals, tax residency issues.
Right.
We'll use some real-world examples to show not just what these things are, but why they really matter to you.
Yeah, and the strategy angle is key here. Like, sometimes the best move isn't just about saving money this year. Take Alex, right? A U.S. expat in Seoul makes $150,000.
Okay.
For his Korean tax, he's got a choice. Standard progressive rates or this special 20.9% flat tax.
And the flat tax probably looks cheaper at first glance.
It does, but then you look at his U.S. taxes, even after using the FEIE, let's say on $130,000.
He still has $20,000 of income subject to U.S. tax, which
Yeah.
he can offset using the foreign tax credit, the FTC.
Right, but get this, here's the twist.
Okay.
If Alex chooses the higher Korean progressive tax rate,
He pays more tax in Korea initially.
yes, but he generates more foreign tax credits for U.S. purposes, excess credits.
And those aren't lost. That's the crucial part. You can carry them forward. Up to 10 years, actually, using IRS Form 1116.
10 years.
Yeah. So he's essentially banking these credits, building up an asset that can shield future income from U.S. taxes. Maybe a big bonus comes along.
Yeah.
Or stock options vest.
Wow. So paying more Korean tax now could mean paying way less U.S. tax later.
It's about foresight, optimizing your global tax position long-term, not just this year's bill.
That's a level of planning most probably don't think about. Are there other procedural things like simple forms that trip people up?
Oh, definitely. Procedures are critical. Look at Mrs. Kim, a Korean investor. She gets a $100,000 dividend from a U.S. company.
Okay.
U.S. law, by default, says withhold 30%. That's $30,000.
Looks steep.
But the treaty, it reduces that rate to 15% for portfolio investors like her.
Good news then.
Yes, but, and this is the catch, it's not automatic. Mrs. Kim has to give the U.S. payer the IRS Form W-8BN. It certifies her foreign status and claims the treaty benefit. And critically, she needs to do it before the dividend is paid.
Beforehand. Got it. What if she doesn't?
Then the full 30%, the $30,000, gets withheld. She can get the extra $15,000 back, but she has to file a U.S. non-resident tax return. It's complex, time-consuming.
A massive headache. All because of one form not filed on time.
Exactly. That simple, proactive step avoids it all. Sometimes the simplest paperwork is the most powerful.
Such a key point on being proactive. Now, shifting to businesses' permanent establishment, PE, you mentioned it's a hidden risk.
A huge one. Take Innovate Inc., a U.S. startup. They send a senior engineer to Seoul for, say, 8 months to provide services on a project.
Okay, seems straightforward. No office, just one person there temporarily.
Right. But under the treaty, that engineer's presence for more than 6 months providing services like that, it can trigger what's called a service PE in Korea.
Even without a physical office.
Even without an office. And suddenly, Innovate Inc. is considered to have a taxable presence in Korea.
Wow. What does that mean practically?
It means they're liable for Korean corporate income tax on the profits linked to that engineer's activities, plus all the Korean compliance, filing requirements, and penalties if they get it wrong.
So a simple service contract just blew up into a major international tax issue.
Precisely. Major tax exposure.
So how do businesses manage that kind of risk proactively? It sounds like it could sneak up on you.
Well, the most robust way, especially for ongoing situations, is something called a bilateral advance pricing agreement. An APA.
APA.
Yeah.
You basically negotiate an agreement up front with both the IRS and the Korean NTS,
Right.
National Tax Service. It defines how your transfer pricing or profit allocation will be handled, how it will be taxed.
So it provides certainty.
Exactly. It turns that uncertain, potentially huge liability into a predictable cost. And underlying all of this, for Alex, for Mrs. Kim, for Innovate Inc.,
Well, let me guess. Paperwork.
meticulous record keeping. It's non-negotiable. Your Korean alien registration card, flight logs to prove presence, the specific tax forms like Form 25555 for the FEIE,
WABN.
official Korean tax receipts, timely FBO filings, that's the Foreign Bank Account Report Form 8833 if you're claiming treaty positions.
It's a lot.
It is. But these documents aren't just admin hassle. They are your defense. They build a credible story for your tax position if the authorities ever ask questions.
Okay, so wrapping this up. Navigating U.S.-Korea taxes, it's clearly not just about the numbers. It's strategy, it's procedure, it's looking ahead.
Absolutely. Foresight is key.
The insights today, banking foreign tax credits, the power of a simple W-8BN, managing PE risk that's really beyond the basic guides.
And remember, this stuff changes. It's a dynamic field. But that foresight, that ability to see how today's decision impacts tomorrow, that's where you can turn potential problems into, well, advantages.
Exactly. Makes you think, doesn't it? What hidden tax assets might you be sitting on? Or what simple form could save you thousands down the line? That's the kind of deep dive that really pays dividends.